Do we classify market type when using monthly systems? This is Bill Scheid from Applied Finance Research, and that's the question we're going to answer in this video. So let's first of all talk about two beliefs. The first is that we should know what market types our systems work in. And the second is that not every system will work in every market type. Those are two beliefs that I was first exposed to by my mentors, Dr. Ken Long and Dr. Van Tharp. And I happen to find those beliefs very useful. And if we agree with those beliefs, if we adopt them and find them useful, then right away that takes us to the question of how will we classify market type? So let's take a look at two different ways to classify market type. The first is the 9 market type grid that if you've studied with Dr. Ken Long or Dr. Van Tharp, you may be familiar with. It's a grid with 2 axes. On one axis we have directionality, bull, sideways, and bear. On the other axis we have volatility, normal, quiet, and volatile. This type of market classification system is excellent for swing and intraday systems, and I've seen that work very well in the past. Now, let's talk about how we do it for monthly systems. Essentially, we define 2 market types instead of 9, and we call them favorable or unfavorable. In other words, it's a good time to be operating our monthly systems and be in the markets that they are targeted towards, or it is not. Favorable or unfavorable. Quite simple. And we define those market types by using moving averages applied to the markets that we are interested in. Now, why do we do that? Dr. Ken Long, who invented the first generation of monthly systems, my mentor, I one time heard him say that for a specialized system, and by specialized he means it focuses on a very specific or specialized market, or in our case it has a specialized time frame, which would be the monthly time frame. We don't want to muddy up the rule set by adding extra layers of complexity. We know that simplicity is an edge, and specifically for monthly systems that is quite a big edge. Now, of course, complexity can be quite alluring, but we know that simplicity works. And just in case we're not sure and we really love our complexity bias, let's just take a look at the results for BMR 21 and BMR 21 with sober. Now, I'm pulling these up because the rule sets for these systems use the very simple market type classification that we were just talking about, either favorable or unfavorable. And we can see for BMR 21, when we compare it to S&P buy and hold and 60/40 stock bond buy and hold, we have a huge outperformance on every metric across the board. We essentially have twice the return of S&P 500 on slightly less than the maximum drawdown of 60/40. We have a compounded annual growth rate of 14.2, a return to drawdown ratio of 20, which blows S&P and 60/40 out of the water. Our ending equity on a hypothetical $100,000 account is quite a bit higher. Excellent expectancy, excellent SQN, and Dr. Van Tharp would call this system excellent. Now, when we add the sober stop, which is our volatility stop, we are essentially adding what we could argue is another type of market classification. We're basically saying, whoop, the market just got too volatile for us. We no longer want to be in equities. Specifically, we don't want to be operating the BMR 21 system. We're saying that because of this spike in volatility, we have now entered unfavorable conditions. When we add that as a second type of market classification, the results get even better. So the point of looking at these numbers is to say, we do use market classification. It is very, very simple. It's either favorable or unfavorable, and that simplicity actually ends up being an edge. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.